The sale was recorded. The product was shipped. On the ledger, everything looked perfect. The payment was expected within 30 days, a standard, unremarkable transaction in a multi-million-dollar corporation. But suddenly, without warning, the amount simply disappeared. It wasn't a bank error, and it wasn't a theft in the traditional sense. It was something far more subtle, buried deep within the accounting software. What if revenue can be reduced, hundreds of thousands of dollars at a time, without anyone in the executive suite ever questioning it? This is the world of credit note manipulation, a shadow game played by those who know the system's weakest points. Today, we peel back the layers of a fraud that bleeds companies dry from the inside out. Welcome to Corporate Secrets. To understand the crime, we must first understand the tool. Credit notes are legitimate, essential instruments in the world of commerce. They are the reverse invoice, a way for a seller to tell a buyer that they owe less than originally stated. In a healthy business, they are used for noble reasons. A customer returns a defective batch of goods, a clerical error in pricing is corrected, or a volume discount is applied to reward a loyal partner. They provide the flexibility needed for the complex ebbs and flows of global trade. Without them, the gears of corporate finance would grind to a halt. But in the wrong hands, this very flexibility becomes a backdoor, a vulnerability waiting to be exploited. When an adjustment is seen as just routine maintenance, it stops being scrutinized. And that is exactly where the manipulator begins their work. In a massive organization, thousands of transactions happen every single day. The sheer volume of data creates a fog. Amidst this fog, credit notes are processed in batches, sometimes hundreds at a time. This creates a psychological blind spot. Auditors often focus on the big sales, the massive contracts, and the flashy acquisitions. But the credit note is quiet. It lives in the adjustments column, a place where professional judgment often outweighs hard rules. This flexibility creates an opportunity for misuse that is nearly invisible to the untrained eye. It's a crack in the corporate armor, one that doesn't require a hammer to break through, just a few keystrokes from someone who knows how to blend in. The question isn't whether the system is broken, but whether it's too trusting. The manipulation often starts with a breach of authority. Meet Rahul, not his real name, but a composite of many we've investigated. He's a mid-level manager with years of trust under his belt. He knows that during the end-of-quarter rush, the authorization process becomes a formality. In some systems, a manager can approve their own adjustments up to a certain limit. Rahul knows these limits perfectly. He begins issuing credit notes for small amounts, testing the waters. There is no supervisor review, no second pair of eyes. He's not stealing physical cash from a vault. He is simply erasing the debt owed to the company. To the system, it looks like a courtesy discount. To Rahul, it's the first step in a much larger scheme. Why bother with complex hacking when the front door is left unlocked? As the scheme evolves, the justifications become more creative. To keep the auditors at bay, every credit note needs a story. The manipulator begins recording fake returns, goods that were never actually sent back, appearing only as phantom entries in the inventory log. Or they might apply retroactive discounts that were never negotiated. Imagine a customer who agreed to pay full price, but on the books, they are suddenly granted a 20% loyalty rebate. The company loses 20% of that revenue instantly. To anyone glancing at the ledger, it looks like a strategic move to keep a valuable client happy. But there is no strategy here, only the quiet redirection of value. The paper trail is perfect, but the physical reality is empty. It is a masterpiece of financial fiction. But the most dangerous form of this fraud requires a partner. Collusion. This is where an internal employee coordinates with an external customer. It's a handshake in the dark. The employee issues a massive credit note to the customer's account, effectively gifting them thousands or even millions of dollars in debt relief. In exchange, the customer makes an under-the-table payment directly to the employee's offshore account. To the corporation, the customer simply negotiated a better deal. In reality, the company's profit is being siphoned off and split between the two conspirators. This level of fraud is incredibly difficult to detect because both parties have a vested interest in keeping the secret. It's not just a breach of policy, it's a professional conspiracy. Once the credit note is issued, the magic happens in the accounts receivable department. The outstanding balance, the money the customer legally owes the company, is reduced. On the balance sheet, the asset simply shrinks. It is a clean, surgical strike. There are no angry collection calls, no legal threats for non-payment, because according to the system, the debt has been satisfied through the credit note. This is why credit note manipulation is the preferred method for sophisticated fraudsters. It clears the trail. If you steal cash, the books don't balance. But if you manipulate the credit note, the books balance perfectly. The revenue simply never existed. The company is left chasing a ghost, unaware that its wealth has already been legally erased. The final act of the execution is the diversion of funds. The customer pays the reduced amount to the company, but the saved portion, the amount erased by the fake credit note, is diverted. This is where the real-world impact hits. The stolen value manifests as luxury cars, exotic vacations, and high-end real estate for the perpetrators. We've seen cases where the diverted funds were used to fuel secondary criminal enterprises or to pay off massive personal debts. The irony is that the company is effectively financing the very lifestyle of the person who is robbing them. While the board of directors discusses market headwinds and margin compression, the truth is sitting in a private bank account in a tax haven, far beyond the reach of the internal audit team. The impact on the corporation is a slow-motion catastrophe. Revenue quietly decreases month after month, year after year. Because each individual credit note might be relatively small, it doesn't trigger a red alert in the finance department. Instead, it's seen as a general leakage or a cost of doing business. But over time, these small cuts lead to a massive loss of blood. Shareholder value is eroded, budgets are slashed, and hard-working employees are denied raises because the margins just aren't there. The company is fighting an invisible enemy, wondering why their record sales aren't translating into record profits. They are looking for holes in the bucket, unaware that the bottom has been intentionally unscrewed. This isn't just a theoretical risk. In one global manufacturing firm we investigated, the pattern of credit note manipulation went undetected for 5 years. By the time the internal audit team caught on, the cumulative revenue leakage had reached a staggering $11.6 million. $11 million gone. Not through a spectacular cyber attack or a dramatic embezzlement scheme, but through thousands of small, authorized-looking adjustments. This is the death by 1,000 credit notes. It is a systemic failure that reveals a fundamental truth about corporate governance. What you don't monitor, you will eventually lose. The leakage isn't just financial. It's a breakdown of the very trust that holds an organization together. The primary reason these schemes succeed for so long is the legitimacy mask. Credit notes look like every other transaction in the ERP system. They have reference numbers, they have dates, and they often have the required digital signatures. An auditor looking at a sample of 10 credit notes might find that all 10 appear perfectly valid on the surface. They have a justification like customer satisfaction or price protection. Without a deep-dive forensic analysis of the relationship between the issuer and the customer, the fraud remains invisible. It's a needle in a haystack where the needle is painted to look exactly like hay. The system is designed to catch errors, not to catch intentional, well-cloaked deception. But the mask only works if the controls are weak. In many corporations, internal controls exist on paper, but in practice, they are easily overridden. Management override is the ultimate get-out-of-jail-free card for a fraudster. A senior manager might pressure a junior accountant to just push this through to hit a monthly target. Or the system's segregation of duties might be compromised, allowing the same person to issue a credit note and approve it. These aren't just technical flaws, they are cultural ones. When speed is prioritized over security, and when trust replaces verification, the infrastructure of fraud is built. The controls are there, but they are hollowed out, leaving the organization vulnerable to anyone with the keys. So, how do you spot the invisible? There are red flags if you know where to look. A high volume of credit notes issued just before the end of a financial period is a classic sign of channel stuffing or revenue manipulation. Unusual patterns like credit notes always being issued to the same few customers or by the same specific employee should trigger immediate investigation. Frequent customer corrections that always result in a lower balance are not just bad accounting. They are a signal of potential collusion. The key is to move beyond looking at individual transactions and start looking at the trend. Fraud has a rhythm. It has a fingerprint. If you listen closely to the data, the anomalies will start to scream. The lesson here is simple but profound. Every adjustment must be justified, and every justification must be verified. Strong approval workflows aren't just red tape. They are the line of defense that protects the company's future. Implementing a strict four eyes principle, where no single individual can authorize a credit note, is the first step. Regular, unannounced forensic audits that specifically target the credit note pool can act as a powerful deterrent. But more importantly, there must be a culture of assurance, not just criticism. Internal audit isn't the police, it's the protection. When every employee understands that the system is being watched, the opportunity for manipulation begins to evaporate. But as we conclude this investigation, we must face the most uncomfortable truth of all. The real risk to an organization isn't a single rogue employee or one fraudulent credit note. The real threat is a system that allows manipulation to happen repeatedly without consequence. It is a culture that looks the other way because the numbers are fine. In the end, the fraudster isn't the one who broke the system. They are the one who proved it was already broken. The question isn't whether your company has credit note manipulation. The question is, do you have the courage to find out? Because in the world of corporate secrets, what you don't know won't just hurt you. It will eventually replace you. If this video opened your eyes, like, share, comment your thoughts, and subscribe to Corporate Secrets.